All right, good morning, everybody. So the drama continues. Markets are a little shook up and are already talking about how war is inflationary. They're looking at the lack of opportunity for rate cuts. And of course, if you unwind rate cuts that were already priced in, then the market gets a little weak, a little soggy. We don't really have a lot of things on the economic calendar today. Read around the world, keep your eye on Europe's close. See if we can get anything back after their market is done. You see Hong Kong down 1%, then the S&P, the Dow, the Nasdaq, small caps more than 2.25%. Got Japan at -3, Europe -3. So a real kick in the face this morning. We got a lot of Fed speakers today. It's very likely they're not going to say anything new. They're all singing from the same hymn book. What are they going to say, right? They're all going to be asked the same questions about those comments made by Jamie Dimon, the war escalation possibly screwing with the inflation expectations and the lack of clear guidance on rate cuts or at least the rate progress. Keep in mind that energy is a really big part of that. And with the Hormuz Strait, it's not closed, but the companies who travel through it have elected to not travel through it because they're worried about being attacked while they're traveling within it. So it's a deterrent, stopping shipments going through simply because they don't want to lose their shipment or get attacked. Still, it's not an official closing, and if that happens, we should see crude or oil at least double, right? Should go from 80 to 160 or 70 to 140, something like that. It should happen very fast. Otherwise, if they can promote some sort of warm fuzzy feeling and get shipping moving back through the strait, that might ease off the crude prices that we've already seen elevated. If you want to keep your eye on the potential for rate cuts or what the market is doing, if it's unwinding or pricing in those cuts, just Google FedWatch. You'll get to this page. It's the CME group. It's free. You don't need to log in. You don't even need an account here. You can just come to this page and then scroll down. You've got the different FOMC dates across the top here. Pick the one that you want, and then you can see how it has moved around over the last month, week, and even in the last 24 hours. It's always helpful if you can find a headline or an analyst or somebody who's talking about it just to kind of maybe see it from different perspectives. In the Gamma Lab Gamma briefing this morning, it talked about on the data front, ISM Manufacturing Prices Index pushed rate cut expectations further out. No 50% chance of a rate cut odds until July per the CME FedWatch tool. So it's kind of exactly what I was just saying. The market's unwinding the possibility of a rate cut, and the term higher for longer is really the mantra, just keeping those elevated rates. We don't have a lot of threat coming out of the White House today. The risk probability is sitting at 25. It's pretty mild, all things considered. So, of course, any sort of gotcha headline or something like that could come in and shake things up. We're just looking at the things that are scheduled to happen today. And looking at the scheduled economic calendar, well, we really don't have anything coming at us today. On the one hand, that's okay, right? The markets are going to see through that and they'll find what they want. But on the other hand, it leaves the market looking for something. And what's the old phrase? When your only tool's a hammer, everything looks like a nail. The call wall and the put wall did not move. We are underneath the put wall firmly in the zero gamma category, well below the volatility trigger. So the expectation of feedback loops is really strong at this point. The cycle has a date to it, though. We've got OPEX coming, and it's going to be a triple witch, which means everything will be expiring. We'll get, futures, options, everything. That's why it's triple witching. Just keep in mind if you're running futures that your contracts will need to be swapped a week in advance. OPEX is always the third Friday of the month. Always. Unless that third Friday lands on a holiday, right? If we're closed for a holiday, then they'll go one day in front of that. But other than that, it's always the third Friday of the month. For the futures, when those contracts are going to expire, that last week, we don't trade the current contract. We go to the new contract. Now, some brokers are going to auto roll you the Friday before. Others, when you come in that Monday, you'll just be on the new contract. And then some brokers, they expect you to do the roll. Right? So that's not really a big deal. You can just check for yourself. Is the current contract getting more volume than the next contract out? And when you see that the next contract out has more volume, then it's time to roll. I have seen people use open interest, but I don't like that one myself personally. There's no wrong way to go. At the end of the day, you do you. Notice the discrepancy between these two prices, 68.83. The March contract, the H series, it's really close to the SPX price, and that's because we're so close to the end of the curve. The next contract, the M June contract, is 69.31. These are futures contracts, right? They're looking at where the S&P would possibly be by July. Higher. It's about 50 points higher at the moment. So when we do get that first week, when we come in and the markets have the brokers have swapped contracts, we're going to see this gap. It'll take a few days, but then the brokers will blend the charts in their magic little way, and then there won't be a gap. So it just takes a couple days, always does, and it always freaks out new futures traders who aren't used to the contract change, and they're inevitably somebody will be on the wrong contract and they'll be upset about the gap and trying to figure out what's going on. Just relax, take your time. It's why I'm bringing it up early. You got weeks before we need to worry about it, but get ahead of it so that you understand what's happening before it happens. You can see the volume right now, right? Like the June contracts are really not getting any volume at the moment, and that's the way it should be because we're not on those contracts yet. Yeah, it is. It is pretty slow, isn't it? Yesterday afternoon, crude was giving us some really good opportunities. You know, you gotta take what you can get, I suppose. So we got crude here, got the breakout, possible fade. You know, right now we're just looking to go back to what you call it, VWAC, get through that, maybe get back inside of yesterday's range. It's that $75 level, right? It's it's more of a psychological level. Oil at $75 a barrel. You know, back in the day when I worked in the oil and gas industry, if the price of oil got too cheap, they would just start stacking rigs in the dirt and they would lay us all off, right? Kind of sucked. But that was back in the day before energy was exported from the United States, right? We used to hoard it all. And now it's a different world. But keeping track of the price of oil has always been um, kind of a really big deal. And we're talking about the oil cost per barrel, right? So there's always been this line in the sand. We don't want it too expensive and we don't want it too cheap. And when we started to really be exporters of energy, the government perfected the stranglehold that they have on price with the strategic petroleum reserves as a part of that. So if you go to crude and you put it out on, say, a couple of years, you can really start to see that range that we've been in where they don't want it, and other than war, right? War is always going to spike things radically, but keeping it between 60 and 80 is kind of the sweet spot. Now, during COVID, war went, not war, oil went below zero. Nobody even knew that that was possible, but all the storage facilities were full. They didn't have anywhere to put it, and they were pouring oil into empty and abandoned caves. That's why oil went below zero, which is, you know, crazy, but that's what happened. So we came out of the whole COVID thing. We had some drama that put us above 100 for a while, and then we've been, you know, settling back in again. So while the government has a really good stranglehold on price, war and the Strait of Hormuz can screw all of that up. Make no mistake about it. We can get excited. We can see big price moves, but we're still expecting at the end of the day, price will normalize as it always does. So you can anticipate that we can, you know, poke outside the box and stretch our legs a little bit, but staying above 100 for an extended period of time would break things around the world. So I don't expect that we're going to stay elevated like that for a long period of time. And that's really what a lot of the drama is about. How that would affect costs everywhere and how those costs would be inflationary and it would just, you know, jack everything up is one of the big things that everybody's worried about this morning. That's where all of the hand wringing and the angst is coming from. These costs, right? So you kind of got an idea of what the market is concerned with, right? Oh, and I'm sure somebody's going to say, oh no, it's the loss of lives and the risk of whatever. It's always money, right? They can talk out of the side of their neck, but at the end of the day, it's always money. Overnight participation is even heavier than it was yesterday. We're looking at plus 200. We haven't seen plus 200 in a while. Like it's seriously, it's been a while since we've had so numbers like that. On the one hand, we, you know, can clearly see we have participation and It's not helpful participation at this point. They're selling us off, but that is what we've got. We're interacting with our VWAP, so at the bare minimum, we've pulled back for a little bit of a reset. The problem with that pullback is we don't know if we're done yet, right? You got the idea. Price doesn't move in a straight line. My drawing tool not drawing. Come on, quitter. Huh. So we've got the drop. We built a little bit of a failed bear flag, and we started the push back up. What the concern is this just a drop and a rally before we drop and go lower? Or is this the reversal and we're going to start working our way back up? We got back to VWAP and we're sitting on top of it. That's a good start, getting on top of it like that. But let's focus on what we have for the Globex. And we're just going to do all of it instead of the way that I would normally do it. So I think doing all of it will be easier for people to understand. 6811 cog line, the halfback. It's just above that put wall, and really it's close enough, right? That is the trouble spot we've got to get through. 6811 cog line, the put wall, the halfback. We can put and in there, but that's our level of resistance that we need to work through. Now the put wall is really close to yesterday's open too. So that's another key level worth keeping your eye on. If we can get through all of that, then we've still got 6850, which is the 0 gamma, the 3-week, the 3-day, and then of course the 10, the 20, the volatility trigger, all of that overhead, right? So a lot of trash and a lot of drama to fight through to the upside, and it's going to start with getting through that put wall or 6811 cog line. Otherwise, the concern is that we're going to roll over, come back down through the 786 and continue that expansion that we begun last night. Right? This reversal off of the low was yesterday's 111, by the way. So we're already done with that. For those of you who know what I'm talking about, you know. We already did the yesterday's 111. So, eh. All right, we've traveled the entire ADR plus some, and now we've come back inside. If we get stationary at this point, we could spend the rest of the day right there, right in between those two lines. I'm not really expecting it, just laying it out there that we could get stuck right here. We could wick out the top of that and, come back down and wick out the bottom of this. It's completely possible. But one thing that we like to focus on is if we get to one side early enough, it's likely we go to the other side by the end of the day, and that would put us up here. Now, all of this is level by level by level, right? What I like to call destination trading. When you have a target in mind, you can take what other path you want to get there. Some people might just buy and hold the contract, close their eyes and hope for the best. And then others might be more nimble, getting in and out, in and out, in and out, as long as we continue to move towards the target goal. So this is a really simple setup and kind of a gift, all things considered, to have something to target. So we've got VWAP. You can just imagine it there. We were already looking at it, so you should have a pretty good image of what that is. 6792 cog line, get through that. We got the halfback. Above that, the ADR half. And then we'll focus on getting back through yesterday's price action. Got the RTH of yesterday with that halfback. Then the Globex high, yesterday's high, ADR half to the upside. level by level by level. And all of that bias is going to start with getting through 68.32 cog line. We just got to get through that ADR level right there, right? Once we're above that level, we can target the other ADR line. It's 100 points away, 107 actually, and that's not a bad run, right? I don't want the whole 107 points, and it's not because I'm not greedy. I'm as greedy as anybody else. I just don't want to sit in this trade for 5 hours while I wait for price to drag its happy butt across that line. So I'd rather be more nimble and, get in, get out as I see fit. You do you. I don't like buying from the high and I don't like shorting from the hole, right? So I'd rather get some form of a pullback that lets me in while I'm not pressing against the high of the run. But again, it's just your own style, right? So we got to get through this red line to get to that red line. That's about as simple as I can state it. Should we reject down here and start working our way back down? Getting below this ADR yellow line offers 67.50, which is the low that we've already tagged it down here. And then below 67.50 offers 66.50. We are running 50, so it's likely that we'll stop at 6,700, but we would still just expect to keep on moving because 66.50, the door is open on that once we get below 67.50. So here's 66.50-ish. It's close enough. And it kind of lines up with these previous pivots down here, right? These previous reversals. Although, to be fair, they are closer to 6,600 than 66.50. All of this might seem like a bit much, but so far the market is moving in a controlled, measured move, and it's not even breaking its own cycles. So price is not acting irrationally. And believe me, it can and it will at some point act irrationally. It's one of the things you want to gauge every day, right? Is price misbehaving? Is it traveling too far, too fast? Is it not pulling back? Is it one-time framing? All of that is a part of just evaluating, is price behaving in a normal way or not? Because a little bit of tip, right, is technical analysis is designed with something very simple in mind. We just look at old price action and try to anticipate new price action based on it. But if markets are misbehaving, then we can't do that, right? Because it's telling us we don't want to anticipate normalized behavior in an unnormalized market. What I marked out here is the high to the low of this range that we've been dancing around in since October, November. 68.11 cog line, we're underneath that. That's a line in the sand to get back up through. We were able to get back up through it yesterday. So far today, no luck. We're still underneath it, so we need to get our way back up through there again. If you keep track of what's going on here, we got these lower highs, and now we've got lower lows. So we are working our way to the downside. Sometimes it's just a little easier to see when you put it into a line. So there's our lower highs working our way down, right? So let's negotiate with 67.50 today. We've got a really nice reversal down here. We just need to see if it holds. If we go back down there and check it, it very likely won't. And that's the threat at the moment, right? Is that it doesn't. And then what, right? We are firmly below the weekly pivot. We haven't traveled far enough to be worried about mean reversion at this point. Getting below the weekly pivot point is a concern, but usually it's more of 3.5 to 4% below the weekly before we need to be concerned with some sort of reversal due to how far we've traveled. And we are only at 2.2 and we're already on our way back up too. So we haven't traveled too far away from the weekly pivot at this point. Today's floor pivot is lower than yesterday. That's bearish. Price opened above it. That's bullish. Kind of cancels each other out. We worked through that pivot. We've already cut through it. There's no value to it. Yesterday's MDP was wiped out midday or even kind of earlier in the day. So we took that off the table. We, of course, need to worry about our S&R lines, see what we've got. We almost made it to R1 yesterday, right? Really close. Hand grenades and horseshoes. Today we've made it through S1, and it's what we're challenging here, right? That 6,800 level. The concern is that we're checking that level from the bottom and that we could just now begin a new leg lower. Because we've made it to S1, that makes R1 the upside target. So if we begin working our way back up through the levels, R1 is 69.32 cog line. It's a level worth keeping your eye on. It's 69.41, really, which is an old school cog line, but it's close enough. Just focus on that 69.30. Of course, to get there, we would have to work through all of the stuff that we've already pointed out. So it's level by level by level. This isn't quite the classic P-shape profile that I'm looking for, but at the moment, it's what we've got. Possibly, if we sell off through the day today, we get a bit of a tail, and then we rally back up off of that. Right, so we would need more of this here to the downside, say down to 6,700 or 6,670 something. And then we would have more of that classic shape. We're completely outside of the value area, and we left that point of control far behind. It doesn't look like we're going to build anything out from these levels. Time will tell, though. It's going to depend on how we manage the 6,800 level. Two ideas for today is that one, we do end up with that classic P shape by putting in a lower tail here, or the possibility that we get a second distribution, right? That we start to build out this area underneath 6,800. That would, of course, leave us this first distribution and then a shallower area and a second distribution. Kind of like this one. Distribution, distribution. Shallow area. We tend to move through shallow areas relatively quick. Nothing to slow us down, right? No speed bumps. $10-day, 30-minute volume profile in TPO. We really don't have a lot here. It's going to take at least a week and a half to get to these candles that made this upper zone. And we're still working on the lower zone. So any move to the upside has to get through 68.75, which is the point of control for the value area here. All those days that we spent just sitting there chopping sideways is now our biggest problem, right? Because we broke below all that, and now we've got to get ourselves back up through it again on the other side. The VPOC from Friday is done, but we did build a new VPOC for Monday, so we still have two overhead. Now, I don't know. We can split hairs on this. We tagged it, possibly. It depends on how you want to draw it. Zoom in and get it to the tick perfect. I'm going to say we didn't hit it. So that's yesterday's VPOC. It's where the greatest amount of trading took place. We need to be able to see it. That'll do, donkey. So we got Thursday and yesterday. Now this is the 26th. That'll do. So that's what we got to deal with to the upside. Remember, we don't want to really focus on those as, resistance or support. That puts bias in it. Focus on them as what they are. They are where the greatest amount of trading volume took place. The most active participation was at that level. The anticipation or the bias is that if we go back to that level, there could be unfinished business. That's the way I like to say it, unfinished business. Trader's remorse is another way to say it. But consider how you would feel if you didn't get the opportunity to trade there and you missed it, and now it's coming back and it's giving you that chance. Or if you had gotten in there, and here we are 24 hours later, we're right back where you got in, right? It's very likely you're going to adjust your position. So it's where the greatest amount of trading took place. It's likely to see elevated volumes or elevated activity. I think that's a more accurate statement. Elevated activity when we get back to that level. So watch the tape, look for spoofing, protection, shenanigans, pulling and stacking around that level. As we get near it, you should see it on the dome and in the active trader. The profiles this morning, it's just a hot mess, right? I mean, look at this trash. There's nothing here to really focus on. We've reached the edge of the weekly expected move, and so far, we're back inside the box. We have a 70% chance of closing inside this range at the end of the week. So we're talking about Friday at the close. That's a one standard deviation because this is based on standard deviation. It's based on range and the math with the square root of time built in on the options participation, right? We can really nerd out on all of that, but the main takeaway is that that's the range of how far the market should move if it's moving normal, and it's the range that we should close within with a 70% chance. 68 point blah, blah, blah. It's just round up to 70. So we can get outside that range. Absolutely. We could even close outside the range, but we want to get back inside the range by the end of the week. We are 1.3% below the 10 week, and I zoomed out to show that's not really a big deal, right? Getting, say, 2% below the 10 week really isn't that big of a deal. Lots of examples of us coming down into the 2% mark and then just turning around and going right back up again. We can get prolonged exposure below that 2% level. And of course, we can hang out down there for a considerable period of time, but it would take something extreme. This April low from last year was all of that tariff drama that eventually led to bond vigilantes attacking the system and forcing the president to change his tune. And it was a buildup, right? It was like 6 to 8 weeks of headlines about tariffs and drama and everybody freaking out around the world, and it knocked the markets down and kept us below that 10-week. So right now, we're not even at the 2%. We would have to get there, get below it, really start to expand beyond it. Then we can have a deeper discussion about the 10-week and our role and where we're at with it. So for now, just keep your eye on how far we've gone to the downside and realize that we haven't traveled too far too fast, and it does not owe us any sort of mean reversion at this point. Same thing with the 10-day. If you haven't caught on yet, the 10-week and the 10-day are pretty much stacked on top of each other at this point. So when we're, 1.3% below the 10-day, we're also 1.3% below the 10-week. That's the way it is. They will diverge, right? The 10-day moves faster on a day-to-day basis than the 10-week. Of course, the 10-week will catch up, but we can expect those to diverge soon, especially if we drag it in one direction. Still looking at this and looking for that question, have we moved too far, too fast? Does it owe us any sort of pullback or mean reversion? And the answer is still no, we haven't. All right, looking at market breadth this morning, we don't have anything positive. A little bit of energy and VIX, which, that's what we had yesterday too. Looking at what's down this morning, everything is down. Even the miners are down this morning. And some energy is down this morning too. So not even all energy is up, mainly just that crude because of the Hormuz exposure. Otherwise, everything else is getting whacked. There are some that look a bit extreme, like the gold miners, but considering how much they were up, like GDX was up about 10% in a 5-day period, and even being down almost 6% this morning, it's still up 4% over a 5-day period. So, at some point it had to pull back. So some of these are red more likely from just a bit of a pullback, while others are just continuing the beatdown that they had already been in. Airlines, for an example, are down 2.5% today, but almost 4% over a 5-day period. If we're looking for that upside move today that we were talking about with all these levels, we're going to need something to get that done, right? The ES or the S&P, the indices, they're not going to be able to do that by themselves. What moves price? That's what we always want to focus on the intraday. What is moving us this time? FX markets, commodities, treasuries, just plain old market breadth, dealer positioning. We don't know until we get into the open if we're going to get any sort of 0-day behavior or strong options influence. So we can't check that, but we can check generic market breadth, and we can look at the Mag 7 and the sectors and see if they're participating in any way. And we just did that. There's nothing helping us move to the upside this morning, not yet. So if that changes, we'll see it, right? We will see the Mag 7 and consumer discretionary and technology, cloud computing, chips, all those guys helping push to the upside, but we don't have any of that. We do have the levels though. Everything is Really, it's just a really nice gift this morning. This is nice, clean price action. It's not like we've got some wadded up piece of bubble gum, right? Some nasty trash price. This is good, clean expansion. So if we run it back up, I would expect nice, clean levels and clear targets. And if we break the low, hopefully we don't just straight waterfall. It kind of sucks when we get that kind of behavior, but it should be clean. This is waterfall, right? Now, for those of you who are unwilling to compromise your time frame, and say you like the 5 and you don't want to leave the 5 and you're going to be on the 5 forever and ever, amen. Well, then, cheers. This is what you're going to get. But if we break this low this morning, it's very likely that that's the kind of price that we're going to see. And if you want something better than that, then just be willing to change your time frame. I know that sounds very obvious, but it is very obvious, right? There's no magic to being on one particular time frame. So let me just wrap up with this today. When markets are violent and volatile, you get really big bars. If you have one 5-minute bar that's 50 points long, 50 points, right? And that's not stretching. We get 50-point bars. You might as well be looking at a daily bar. So if you're intraday trading, how many of you trade off of the daily? I mean, don't get me wrong, I have, and I'm sure I will again, but this is not your default chart for intraday trading, right? It's the daily chart. These are daily bars. If your 5-minute bar is so big that you can't do anything with it, you might as well be on a daily. So go to a time frame that gives you something to read, because I don't know about you, there isn't much to read here if I'm looking for a way to get into this. Got to have a two-way market. So got to get into a smaller time frame to be able to see the opportunity to get in. The time frame I recommend is the one that allows you to see the opportunity. That's not being cryptic, that's just being straight fair. If you can't see the opportunity here, then guess what? You need another time frame. Try another one. Try something smaller. Go to a 4, go to a 3, go to a 2. Two's good. Absolutely nothing wrong with 2. I use a tick chart when I trade, and I really like the tick chart, but not all platforms have a tick chart. Or if you're on TradingView, they want you to pay for a tick chart, which I don't want to do just from the principle of it. I refuse to pay for that tick chart just straight out of principle. So, use something so that you can see inside these candles. That's all I'm getting at. When you have a candle that's so big, it's worthless, it might as well be a daily bar. And none of us would trade a daily bar, right? Well, I mean, I do, but so old school analogy, we'll just sum it up here. When this is too big, all you've got is open, high, low, close, and you can't see anything. But there was good price action that day. If you had been able to see it, you probably would have traded it. Then you can go to a 65-minute. Oh, wow, yeah, that 65-minute, it's really big too. Open, high, low, close. I'm sure there was some good price in there, but I can't see it because these candles are too big. Just keep going until you get to a time frame that shows you something inside of those drama bars. Drama bars. That's going to be the new t-shirt, right? So that's the idea. I don't want to stay on a 2-minute or a 1-minute or a 30-second chart. I'm not interested in staying there all day, every day. I'm just pointing out that when you can anticipate that sort of behavior, then, have a plan. I tend to run multiple time frames myself. So if it starts to happen, I'm already going to be seeing it in a different light. But if you don't have as many screens as I do, or you just don't have as many windows, then anticipate that we could get this in a breakdown today and be ready to swap your chart time frames to something a little smaller. Cool, cool. It will help, I promise. Because all you're looking for is an opportunity to trade. And if you can't see inside these big bars, then you don't really have an opportunity. Then you miss out, and that sucks. So what I got for you guys, be careful, be safe. I'll see y'all tomorrow.